One of the tricks that we've used in the banking system to get delinquencies to come down is note-on-note financing. Just get the shit off the balance sheet. But the other leg to that was we just lower payments. And we lower payments on such a massive amount of loans that we don't ever really have to take losses anymore. But the problem with that is extended pretend predicts bank failure.
Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Bill Moreland, thank you for joining me on The Debt Doctor.
My pleasure. I appreciate the time, the opportunity to get some time with your audience.
I am so glad this is becoming an annual event. This is like my holiday bonus to the world of my people, that I am bringing on someone this smart about the world of banking. To background for those that don't know you, Bill, you are the founder of BankRegData. This is an online tool that I subscribe to. And you're basically focused on taking the huge amounts of bank call report data that feeds into the federal system and creating a very easy to use way of looking at that data and kind of using it as a tool to kind of understand what's going on inside the banking industry. I know you're going to share with us some of what you're seeing today. You have these great monthly reviews. Sometimes you dig deep into the banks, and I just want to say thank you for what you're doing. And I'm sure we're up for an exciting conversation.
Yeah, I appreciate it. Yeah, the call report data is, it's been around for a long time. And that's the reg and the less than exciting bank reg data. Reg to a banker tells them call report. But essentially, it's a wealth of information about a tantalizingly amount of information regarding bank performance, because it's a risk document. It's a document that's basically put together for the FDIC to use to set depository risk assessments. So they have insurance rates, and this is the document that they use to set those. So we repackage the data, push it back up. And we have a number of regulatory bodies that use it to subscribe.
You've pointed out some things in the past that have been very kind of prescient. And one of the conversations that I know I want to get into today is a new classification in the reporting that just happened as of last year, something called NDFI loans. These are loans from banks to other non-bank lenders. So I don't know if we can jump right into that, or if you have some other topic that you think is really we should start with. But NDFIs are, I think, where it could leave. Why this is an important topic is you've got a lot of folks in the private lending space. Private credit has grown so significantly, and those non-regulated private lenders are getting bank-regulated loans, and we're starting to see that maybe the collateral isn't as strong, maybe the underwriting guidelines aren't as good, and this could be, there's a reason why the feds, I assume, have added this classification, and you maybe start with that.
So the NDFI classification it stands for non-depository financial institution lending. So it's lending to companies that lend that don't have deposits. So it's basically wholesale funding, that type of stuff. It's been around for a long time. The classification itself is a unique identifier, goes back at least to 2012 when we started picking up that expanded data set when the thrifts disappeared and went to the OCC. So when that happened, we were able to get the larger data set that was available. And NDFIs were all the way back there. And if you let me share my screen real quick, I'll show you the
Yeah.
history. Uh, but basically, what happened in 2024 Q4 was the FDIC kind of, and when I say the FDIC, I really should be saying the FFIEC, which is the larger umbrella. The FDIC is the insurance arm; they do some regulatory, but there's also the OCC, which is the big banks, and the Fed as well. So the three of them are the kind of combined regulatory entity. The FFIEC is the one that's the umbrella that captures the data, captures the reporting. There was clearly a desire to get more information about this. But as I've been doing these quarterly updates that you've been receiving, it's called an asset review, and they're free. Anyone can sign up to our mailing list, and we're happy to mail you our stuff. But basically, we've been talking about how NDFIs have gone from $100 billion to 1.4 trillion. And so I've got a little bit of data here, if I can share my
Yep.
screen, and basically to give you an idea what the scope is. So what this is column C is total loans outstanding in the bank system. D is non-depository financial institutions. I've added in purchase carry securities. these are
Mm.
these are margin loans, right? These are loans to speculate into securities. And then all other would basically be total less these non-depository financial and purchase carry. This is
Hmm.
this is everything. This is going to be commercial, industrial, residential, consumer, auto card, multifamily, construction, everything. So what you're seeing here is back in 2012 Q1, there was $7.4 trillion and NDFIs made up 78 billion. So about 1% of total outstanding loans in the United States banking system were to third-party intermediaries who were then lending to their client base. So
Mm.
a good example of this would be a small business lender. And just to give a little backdrop on me, I am a credit collections guy. I
Hmm.
basically have built front end authorization teams to do underwriting. I've managed collection strategy, and I've done managed collection shops. And I've done this for First Data, American Express, and Wells Fargo. And so a good example of non-depository is potentially a competitor of Wells Fargo's small business shop that I was part of back a good 25, 27 years ago. Basically, instead of going into your local branch to get a business loan, like BankRegData would get a loan, small business, been around for a number of years, but realistically, there's not a lot of assets. The loan is both to the business as well as to Bill Moreland as a person. There are intermediaries who do that. And so basically, instead of lending direct through your branch to BankRegData, they will lend to an intermediary. And there's a bunch of them. I think there's a couple in Atlanta. So they give them wholesale funding, and then they go out and basically lend to small businesses. And sometimes it's backed by assets. Sometimes it's backed by receivables, right? Factoring. But you can see
Hmm.
it was a very small portion of the total pie. Purchase carry securities at this time, and these are loans to basically buy securities. So they're essentially going to be for speculation. You can see with 61 basis points. The
Right.
vast majority of loans in the banking system were your traditional loans: residential, commercial, industrial, commercial real estate, etc. Fast forward to 2022 Q3, and you can see the number has climbed to 737 billion, 6%. Purchase carry is more than 2.5 times increase. And we also see a lot of growth in the base economy. But if you will notice, if we go basically this time period right here, which is just over 4 or 3 years, and essentially what are we talking about? 14 quarters, 13 quarters. Basically, total loans have gone from 12 trillion to 13 trillion, NDFIs have climbed to $1.46 trillion. And you'll see a huge increase right there. And so this basically was a reclassification dilemma that went on. Notice how the all other loans shrunk, the
Mm-hmm.
purchase carry securities skyrocketed, and the non-depository financial institutions. And then since this time frame, we continue to see massive growth. Now, the important thing to remember is a bunch of this extra 300, right, is that $250 billion. They
Right.
were back here, but they were called something else. They were called commercial industrial. They were called, consumer lending, especially in the purchase carry. So part of this big jump in the red numbers is a quarterly increase, but it wasn't like they just went out and did massive amounts, right? $260 billion of purchase carry. Those loans were always there. Banks were reporting them somewhere else. And
Mm.
so what we're finding right now, and I'll come back to these numbers in a second once I turn my screen off, but we're looking at 11% of the total loan book in the United States is to intermediary lending. And you could argue that there's been no real lending at all during this time frame to the real economy. Now, that's not
Mm.
entirely true because we know that there's a big reclassification, but net, if we were reporting apples to apples across time, you can see that the vast majority of lending in banks, and mostly we're talking the biggest banks here, is going to be speculation loans and intermediary loans.
The last 60 days, we've seen a lot of these large facilities. We've seen a few banks kind of caught up in exposure to large facilities or large investments that they've made uh, to either other lenders or private companies in some cases that didn't really have collateral back or fraudulent situations going on. It seems like every week now we're seeing another major failure of a facility. Did the Fed see that coming? Is that why they went and started reclassifying this a year ago?
I can't speak to that. The problem that we run into is NDFIs, all other loans, are now the second largest loan portfolio out there. So what's happened is it's ate the rest of the call report, but it happened kind of slowly, right? And so what's happened is we don't have, up until 2024 Q4, we had no real understanding of what they were. And I would argue we still don't. There are some classifications. There's mortgage, there's consumer intermediary, there's business intermediary, there's private equity, and there's other. Um, I would tell you, I think we're going to go through a painful education on what we should be asking. I don't think those are the right things. So, for example, mortgage is one that everyone says, well, that's so straightforward, right? No, not really. Because basically, it's changing the relationship to the FHLBs, the Federal Home Loan Banks, where banks go get loans from the Federal Home Loan Banks. And I could argue that I don't like any of that. I think the mortgage is the solution, but it is what it is. But what we're finding is FHLB advances are declining at the same exact time that these large banks are going out and doing massive wholesale lending in mortgages. So it's totally going to start distorting a lot of that fundamental plumbing. And I don't know enough about that to get into the rabbit's hole of what this is all going to end up being. But in the short run, the FHLBs are now having right, they're potentially losing business, right? They're losing business because the large banks don't want to lend in mortgages anymore. They'd rather lend
Hmm.
somewhere else. And part of the reason for this is, and there's some confusion on this, but I believe there are advantages to NDFI lending.
Hmm.
So on one hand, what you have from a bank's perspective, on one hand, what you have is banks saying they need capital relief. Now, when we say capital relief, let's be honest, that's not capital relief. It means they want more dividends.
Right.
Because if they basically have to hold higher capital levels, they can't pay out as much as they want in dividends. So the Bank Policy Institute, which is the mouthpiece and the lobbying arm of the largest banks, capital relief, capital relief. That's why you hear we're more capitalized than we've ever been. That's not true. Um, that's not at all true. When you start looking at individual banks, it's an illusion because they're managing their risk-weighted assets by, shrinking the balance sheet. Even though they're burning capital, they're selling off loans faster, and so it looks like they're more capitalized. Flagstar is a perfect example. They're not.
Right. You
They're not more
you did a
capitalized.
great piece on Flagstar
Yeah,
about that exactly.
they burned through almost all that $1 billion in extra capital that was put in. 900 of it has already been burned in the last 2.5 years. So NDFIs, so banks want more dividends, right? They want to pay out. They don't want to hold it as retained earnings, which turns into tier one capital. They want to pay out more dividends because their compensation is tied to that. Yay, stock options. And I get it. I understand it's valuable. I also have sat on executive teams and made bad decisions because our compensation was tied to the stock. So
Right.
I understand both the pros and the cons. And I'm more and more convinced as I get older that there's maybe more cons than there are pros. But I get it. That's not a universally favored opinion. But banks want more capital relief, more dividends. Policymakers, and I'm going to lump everybody in there, governments, right? And red tie, blue tie, my observation is we don't really act any different when it comes to this type of stuff. And the reason for that is nobody wants to take pain. And sometimes that pain happened under a different administration. And so the last thing we want to do is clean that pain up, right? And that's why we've put our finger on the economic cycle. And we used to have them every 5 to 7 years. Now we
Right.
push them out. Now we think we've solved them. We'll never have one in our lifetime
Right.
again, Janet Yellen, right? So basically, policymakers don't want to take pain.
Right.
But they also want stimulus and growth. And so I tend to think in terms of metaphors. And I also think in terms of bell curves, right? I'm a predictive modeling kind of guy. Coming out of 2012, 13, and 14, we had gone through a lot of pain, right? But we needed to. And the reason we went through a lot of pain is because we had a lot of excesses because we did silly things with interest rates. But that's not what we blame that on. We blame it on, right? Banks weren't doing the right things and people got crazy.
Right.
But it was low interest rates, right? Low interest rates drove all that. But coming out of that mess, banks had stopped lending. And so their book got very, very clean, primarily through charge-offs. But the ones that survived had very clean books. Also during this time, we weren't doing a lot of lending. So when banks wanted to put a foot back into the swimming pool to lend, if you go back to the bell curve of super high credit scores, low credit scores, and then the bell curve, the big giant normal distribution, there were a lot of people at high credit scores, both businesses and consumers, that you could lend into in 14, 15, 16, 17, right? And so as you get longer in an economic cycle, what do risk managers have to do? They have to dip deeper into that less safe pool. So you work your way through that bell curve. Every risk manager knows this, and they know when they're starting to compromise their lending standards. And that's always the dilemma. That's because the only way we can grow now, and that's why you start having cycles of acquisitions, because that's the way to grow rather than organic growth. But inevitably, the longer you get in the cycle, the deeper in that weaker credit pool you get. We were there in 2019. We were starting to crack. You were seeing across a number of portfolios, and this isn't observations. This is me looking at data, right? This is me looking at commercial real estate delinquencies, ag, farmland delinquencies, consumer delinquencies. Our delinquency rates were climbing, and that all got washed away. And so one of the things that I wanted to share with your audience, if I could, is we didn't just, and we'll come back to NDFIs, but this is
I want to hear how it got washed away, because that was another thing that you and I have spoken quite a bit about, the TDR, the CECL, all the kick the can down the road kind of stuff that went on, and especially and how much of it exists still.
Well, it's still all there. So what this green chart shows, these things don't come out of nowhere. And so you can see what I've been talking about is 14, 15, 16, 17, 18. You see, and this is total deposits and all of the entire US banking system in trillions. The yellow line is baseline from 2015 to 2019. We got into 2019, and towards late stage of 19, Q3 and Q4, delinquencies were going up. And it was obvious we were inverting. Then all of a sudden, that all got washed away. And I'm not going to litigate or relitigate what happened in 2020, 21, 22. I'll just say, from a bank's perspective, notice how total deposits went from 14.5 trillion to almost 20 trillion in 2.5 years.
Wow.
And I think people don't really understand this. It was supply chains that happened inflation. No, it was Milton Friedman's correct. It was money. This is
Mhm.
thing two, basically. And so all the money that gets printed, and whether it's a PPP loan or restaurant stabilization fund or just printing money and sending to people, or the Fed just printing money and buying MBS and treasuries, there's always money somewhere that's made and created. That flows into a bank. So this is a perfect illustration of what happened. So going from 14, so if we were to say that yellow line would have been normal printing inflation growth, there's
Mhm.
probably about an extra $5 trillion in the system on top of about a $15 trillion base at this time. So if you wonder why everything is 35 to 40% more expensive, it's because we created 35% more money and dumped it into the system. So that explains inflation, a huge part of inflation, but it also created a dilemma for banks because that's a liability. So now they have $5 trillion of more liabilities. What do you do with that? Well, the ones that didn't fully understand, they went out and bought securities. So the
Hmm.
green chart, once again, is still the deposits, but I've overlaid a purple chart, which is securities. And so you can see at the end of 2019 Q4, when we were at 14.5 trillion, we had $3.98 trillion of securities in the system. These are mortgage-backed securities, treasuries, munis, non-government agency. And you can see almost peak went to 6.26 trillion. So Silicon Valley Bank did not come out of nowhere. It came out of them being closer to the trough, and they went from a $60 billion bank to a $200 billion bank, and they went out and added $105 billion of treasuries and mortgage-backed securities. Why? Because anybody under 37, 38 years old up until this time pretty much only realized 0% interest rates as an adult.
Right.
So their baseline is zero. It's going to go back. And when it goes back, everything's going to get care of. Anybody over 37, 38 years old at that time realize zero probably is not normal unless we've somehow changed the economic rules of 2,000 years of history, that there was going to be a normalization. So what you're seeing here is that the early 2023, late 2023 problems with Silvergate, Silicon Valley, Signature, all those banks, that was because the government printed $5 trillion, and the banks that didn't fully understand the risk profile went out and put 2.25 of that into work in securities.
Mm.
But now you see but that's not the entire thing, right? There's $3 trillion
Right.
out there. So the wave of issues that we had in 23 were caused by money printing. The wave of issues we had in 24, 25, and continue to move forward in lending is the same thing, but it was delayed. So you'll notice that from 2019 Q4, we had $10.52 trillion of total loans. It actually went down. Now you'll see a big jump there of about 400 billion, and that's PPP loans, right? And that's just printed
Mm.
money. Those aren't real loans. They're just loans that were just given out, and the banks had them on their system. But you see that they slowly worked down until 21 Q1, they were at 10.82 trillion. But notice how their peak a couple years later came a year and a half, 2 years later than that 19.93. So 12.45. During this time frame, there was 229 billion of new commercial real estate and 293 billion of new consumer. So basically what you have going on here is mark to market losses in securities come from money printing.
Mm.
Poor lending decisions come from too much money being pumped into the system, printed. So NDFIs became an outgrowth of this where they went into overdrive. So my examples of NDFIs before we had the mortgages, consumer intermediary, business intermediary, were two things. One is there's people buying commercial real estate off bank balance sheets that's not doing so well, and the bank is giving them money to take it off their balance sheet. So they would take and there's a prime example of this. And I got to be a little bit careful, but I'm going to go ahead and share the data on this as well. JP Morgan Chase, and we go into their loan portfolio, and we go into their commercial real estate non-owner occupied portfolio, and we look at their NPLs.
Yep.
So basically what you have here is you notice how their delinquency started to climb. And the reason the delinquency started to climb is because we did so much lending in 22, 23. And as those loans, now here, and you see this, there looks like there was a reclassification that took place. That does happen. But you can see they went from 27 to 35 billion. That's a lot of new loans that are coming in. Notice how the delinquencies went up. So when you have a wave of lending, every collection manager and underwriter is going to say you're going to have a wave of delinquencies, but they're delayed. So these are echoes of the money printing that took place in 2020, 21, and early 2022. But magically, notice how they get better. And it drops $300 million. All right, well, I have some insight on this. During 2022 and 2023 early, what was happening was banks were selling their commercial real estate loans. They had to get it off their bank books. And the reason they had to get it off their bank books is because every one of them had this horrific growth in NPLs and the NPL percentage. This is they're the largest lender in the space by far. I mean, they were sitting at 70 billion. You now see they're at 62 billion. How did you drop 10 billion, right? You're selling loans,
right?
And you're not lending anymore. But you'll notice the same chart. Delinquencies climb through the roof. The percentage climbs through the roof. It stabilizes and then starts to come down. And you see the same thing with Bank of America, who's the second largest lender. They go up, they stabilize, they start to come down. JP Morgan, they go up. These are the three largest players. Now, it's good that they're coming down. No, maybe not. So let me tell you what an NDFI can be. An NDFI could be a bank has $300 million of a commercial real estate loan in Chicago. And that bank is JP Morgan Chase. Balance sheet JP Morgan Chase. They don't want that $300 million on their balance sheet because in commercial real estate because it's not performing and they don't want to have to mark that down if people start taking losses. That can now be worth 200 million, right? They could take a big loss on this. And so they call up a number of big firms that buy these properties off their bank balance sheets. And they say, look, we will give you 90 cents on the dollar to buy that $300 million property in Chicago. And I'm like, really? And I heard this story from two separate parties at the exact same time frame going back 9 to 12 months ago.
Wow.
And I said they started at 90 cents on the dollar. And so for the audience, this means that they have a $300 million commercial real estate loan. They give the private equity group $270 million in a low interest rate loan, and they call it a C&I loan. So what they're doing is they're laundering, and that's what I call it. They're laundering their loans from CRE to C&I, and they're giving 90 cents on the dollar to the private equity firm. So the private equity firm puts in 30 million. So what the bank will say is they've had a loan to value that goes in the right direction because there's now a capital buffer. But if the property is only worth 200 million, you're going to very quickly, and it's non-recourse, it's going to come back on the bank's balance sheet. Both the one client, one prospect, or someone we were trying to pitch BankRegData services to, turned it down. And
really?
Then JP Morgan came back and offered him 100 cents on the dollar.
Wow.
Non-recourse. So when you see a drop of almost $300 million during this exact same time, when I know that they're out shopping this property, understand they were putting those in C&I,
Mm,
but they weren't C&I. They were
right.
really NDFIs. But the
Right.
regulators didn't really and there was advisory firms out advising people to do it this way, banks to do it this way. And so the regulatory understanding was that this was not a wrong thing to be doing. But obviously, what you're doing is you're taking a commercial real estate loan and you're making it a commercial industrial loan. So what happened was the regulatory bodies came in and said, look, we can't have that. But what they came up with where essentially we'll go to the industry, we'll go to loans. And so what you'll see is this big drop in C&I basically in 2024 Q4. It drops 110, 120 billion dollars. Well, it didn't just drop, they were reclassifications that were probably note on note financing.
Mm-hmm.
So one, you have the issue of, wait a minute, the commercial real estate really may not be getting better. Banks just may be pushing that off balance sheet and funding it at 90, 95, 100 cents on the dollar. Non-recourse, yeah, it can totally come back in 26, 27, 28, right? So I think we're buying more time by allowing this. But when we were calling them C&I loans, it looked like we had a lot of robust growth in the economy. But that's not what was happening. So you come down here, look at number 2. All other loans now is number 2. It's bigger than C&I, bigger than CRE, bigger than credit card, bigger than multifamily. This used to be right here, going back 10 years ago. All other loans are, and so you see that big jump right there in 2024. The big number of them are NDFIs. And
Mm.
so one of the things that happened was a reclassification of C&I loans into these other categories. But notice how in here, there's nothing that says, well, how many loans do you have outstanding to your own loan book on note financing? How many loans are backed by real estate, but we don't know that they're backed by real estate? How many of these loans are subprime consumer lending, but we don't know that they're subprime? So sitting there saying they're business intermediary, that doesn't tell me anything, right? I mean, it may give us a comfort level, but from a risk perspective, it doesn't tell me if this is vendor financing, right? Or if it's legitimate. It doesn't tell us the length of the time. The biggest problem that we should have with NDFIs, and I say this as a risk manager, is we're dissociating the risk decision from JP Morgan Chase to a different firm. So we would have to assume that JP Morgan Chase and Wells Fargo and Bank of America probably have a lot of clones of Bill Moreland. Some probably way better at risk than I am, maybe 70, 80% not as good as I am because it's an art. But you would like to think that the most sophisticated financial institutions in America have the best risk managers. So when you then abrogate that risk decisioning to a third party, that should raise concerns. Are we sure that that third party is going to have as good a risk decisioning as JP Morgan Chase and Wells Fargo? The second thing that should be worried about the dissociated risk decisioning is the fact that basically what you go back is things change. And so
Mm-hmm.
I was a risk manager right in my 20s at Telecheck, building a lot of their infrastructure about predicting bad checks. And then when checks bounced, predicting which ones would collect. So we did a lot of work with FICO, Fair Isaacs. We did a lot of work on our own, built our own infrastructure, built a team of 35 people involved in doing this. We got pretty good at it. But then one by one, we all left and went to Amex or Wells or PNC. Then I got acquired back into that company 10, 12 years later. The risk was nowhere near as good. So not only do you have the dissociated risk concerns, you have a longitudinal concern. If you have an ongoing loan outstanding to a business intermediary, are we sure that their risk skills, one, are at a level that's near ours that we're comfortable with?
Right.
2, are we comfortable that they'll maintain that level or get better, or will they get worse? And I think we all realize sometimes companies get worse, right? Sometimes just the staffing or whatever doesn't work out. So NDFIs are this real big brown box, black box, if you
Yeah.
will.
Very opaque. Yeah. Yeah, very opaque. And it's interesting. Wait, as I'm sitting here looking at the going through the CRE loans in particular. I think of the one point of the over trillion and a half of the NDFIs. I think about, if I remember correctly from your last thing, is about 350 million of it's real estate directly related, and then the majority of it is non-real estate. And I find it interesting because the banks have wanted to decrease their CRE risk, but in some ways, I mean, that to me, still real estate is still a real asset. I remember going to ABS conferences 15 years ago. The majority was first lien mortgage securities. And obviously that blew up in a bad way for reasons in 2008. But those derivative markets are still 5 times, 10 times what they were in 2008. But now they're associated with factoring, merchant banking, other types of asset-backed collateral that if I was, I mean, I don't have nearly the risk management experience that you do, but I would think that there's a real opacity if any of those loans go bad in terms of like whether or not there's any collateral really supporting it. Have any thoughts on that?
Well, so yeah, I mean, we don't know what it is, right? We have no way to really track. And even the mortgage stuff, there's a belief that the mortgage stuff is gold. We're fine. We know what that is. But I don't think that's entirely true.
Mm-hmm.
How I know that some of those loans could be loans to non-insurable condo mortgages.
Mm.
So what is Florida, right? So all of a sudden you have all these condos that their association dues go through the roof because now they're worried about structural
Right.
sinkholes, right?
Reserves. Yep.
Frightening, right? Frightening
Yep.
stuff. So these people have a hard time getting mortgages. Well, some of those mortgage intermediary lending firms are doing non-insurable condo mortgages.
Hmm.
And so what I've also come to realize is my most extreme example that I can come up with pales in comparison to reality. And what I mean by this is I always used to tell people NDFIs are, let me give you some examples of what NDFIs, and this is going back a year, 2 years, but because you can see what was happening from my perspective, because we have clients that are on the other side of that transaction. They're doing
Right.
the NDFI, or I have advisory firms like big entities that are advising them, and they're like, dude, take a look at page 36. And you go look at their deck, and you're like, oh my God, they're exactly doing this. Do people not realize that commercial real estates are being laundered into C&I? But one of the examples, in addition to the CRE loan laundering, if you're doing self-funded note-on-note financing, the risk is not going off your balance sheet.
Right.
It's hidden. If you're doing funding for someone else's to buy off some other banks, you still have risk, but the other bank is gold. So one of the questions I'd ask for NDFIs is how much is note-on-note financing for your own book, and how much is note-on-note financing for wholesale, taking it off someone else? Because if it comes off your own book, it's not off your book. But if you're not funding that, someone buys it off the book, you're gold. It's on someone else's balance sheet, but we have no way of knowing that. But a secondary NDFI example that I would use, and this is a real example, is you can't get your used big rig truck finance through your local community bank. Come to Bill's. Bill's used truck lending, used truck funding never turns anybody down. No credit score, no turn. And that is an NDFI. And so that was always my kind of worst case example of like, dude, seriously, that is literally a firm. And there may be great risk around it, but it shouldn't be a 6-7% yield, right? You're hoping that,
Right.
and then you get into if it's so when we looked at Tricolor coming down, little did I
Mm-hmm.
know that that would be horrendously worse than Bill's used rig truck financing, right? You're talking about people that don't have credit scores, don't have social security numbers, and they
Right.
don't have driver's licenses. And I don't care where you sit on the side of the table of, well, we should or no, we shouldn't. Banks would never lend to those people.
Right.
You could not, that demographic could not walk into JP Morgan Chase branch or Fifth Third branch and get a loan with without a lack of those three things. So why all of a sudden are banks allowed to lend to someone else doing this? Surely they had to know. Surely
Yep.
they had to know. And if they didn't, then slap them. They shouldn't be able to do any lending, consent orders, because you're losing your fiduciary. But I honestly believe that what was happening during this time, banks didn't want to lend anymore because we had grown so deep. So this comes full circle. We went
Mm-hmm.
so deep into that credit curve, 2015, 16, 17. We're now working our way into 18, 19, and you're seeing the cracks. Then all this new money came in, and then everybody got safe. We had an artificial consumer. We had an artificial business because nobody had to pay rent. No one had to pay mortgages. No one had to pay student loans. They're all great. Those are economic stimulus things, right?
The
When
good
you,
days of COVID. I call it the great vacation.
yeah. And so what happened is everybody looked safer on that risk curve because 570s, 580s and credit scores, they weren't getting dinged on a missed card payment. They weren't getting dinged on a missed auto payment. They weren't getting dinged on a missed student loan payment or rent. Now they didn't have to make none of those payments, right? And then they could. So what happened is a lot of people had an inflation of their credit score, both businesses and DNBs and consumers. And that came at a time when banks needed to lend because they had 5 trillion extra dollars, 2 trillion was on securities, 3 trillion needed to be doing something. Let's go lend to those people, but they were fake, they were artificial. So I think what was happening as we get deeper into that was banks didn't want to lend anymore. And you can see it in the biggest banks. They don't lend to
Mm-hmm.
the real economy. All big bank lending is purchase, carry securities, and NDFIs. It's the community banks that are keeping Main Street with new loans coming in. Because community banks is a tranche, is a big group, are incredibly well positioned. It's the largest banks that have the problems. But that's not what the press wants to tell you. They want to tell you it's the community banks that are a problem, the big banks. Well, that's because the big banks are the ones that advertise, right? So
Right.
basically, NDFI lending was a way for policymakers to say, we need more stimulus. Banks say, we don't want to lend. We want capital relief, which means more dividends. So I think the wink, wink was, you know what? NDFI lending can have lower capital requirements, lower allowance requirements because you're an intermediary lending to someone else. And that's how they were pushing these loans out into the economy to keep the stimulus going. And they moved it in such a way that propagated risky lending by its
Yep.
nature. So there's no way that these banks would have been lending in their branches. Why did they get a get out of jail card free? Why are we
Right.
not hearing about lawsuits, right? I mean, the FDIC or the OCC, they should be going, the Fed, they should be going after these banks saying, what were you doing lending to people that had no documentation, had no credit scores? I mean, and yet you hear nothing, right? And so I got to believe that that was part of the agreement back in 22, 23, and 24 is we need more stimulus. We need more economic growth. You got to do it. And we don't want to do it. All right, we'll come up with NDFIs to do it.
Interesting. That is very interesting. And you see some of the more sophisticated, the large banks, some folk, you hear Jamie Dimon talking about a concern there. I don't know if that's just bluster to try to stave off, whatever their own involvement may be down the road. But there's some of the other senior executives that have said their biggest concern, even a year ago, were these non-bank lenders. And I'm wondering if they might become the new target. Our good friend Chris Whelan broke something on Bloomberg yesterday. It was kind of a little bit of a scoop, or 2 days ago, because he's heard from several non-bank mortgage lenders who are getting calls from Pulte office saying they are preparing to require capital increases for these folks and that this is a storm that is about to get unleashed in December. Do you
Huh.
think that that is something that is kind of a protectionary measure for the banks, or where do you think that's all coming? Any thoughts on
Yeah, I
that?
couldn't speak to that. I don't know. And this gets
Yeah,
back to what we talked about a little bit earlier is I don't think we're smart enough to know the questions to be asking in the call
that's
report
exactly right.
yet. We're going to have to pay for a very painful education because I
Well, if
think,
we keep having a tricolor, first brand, Prima Lend, I mean, it's every week is a new thing. BlackRock had to write off $150 million line. I mean,
do you think
I
they're
mean,
the worst? Do you think they're the worst? Do you honestly think that the worst things that we have seen came first? Maybe, hopefully,
no
right?
way.
I mean, I got
No
kids. I
way.
want them to be able to find a job, but I also want them to be able to buy a house, and maybe a little bit of value destruction is not such a bad thing. Just
Ah,
going
amen.
back to 2019 would be okay, right? If we just
Right.
went back to 2019 prices on cars, on autos, on goods, I would be a lot more optimistic about my children's future than I am now.
I
But
100% agree. It's so funny because, I was one of those people who thought I was watching the markets in 2019, especially living in Florida where I owned 80 or 90% of my real estate at the time. Things were getting so frothy there. And so I started to sell, and pay that just to get off to get that. And I'm thinking, oh, then COVID hit. I figured, oh, the world's going to just evaporate. I made the right decision. And then, of course, I was the idiot because I left 35, 40% on the table in all of those deals. You're right. Even coming back to 19, that felt a little froth. I have a 32-year-old who's trying to have his first kid, trying to buy his
right,
first house. There's no prospect for any of that. So
right.
really, the only way, in other words, is some value, some kind of reset. I would assume.
Look, you cannot. So we didn't get into loan modifications. We can do this down the line. But one of the tricks that we've used in the banking system to get delinquencies to come down for JP Morgan, Wells Fargo, is note on note financing. Just get the shit off the balance sheet. But the other leg to that was we just lower payments. And we lower payments on such a massive amount of loans that we don't ever really have to take losses anymore. But the problem with that is extended pretend predicts bank failure. Quite,
Right.
it's probably the single best predictor of this. And I got numbers and I can share numbers, but it is probably the single best predictor of bank failures in 28, 29, 2010 before, right? As we were heading into the storm, banks that were doing a lot of this at the beginning, they disappeared. 30, 40% of them were gone within 2, 3 years. So
Interesting.
the levels now are unprecedented to the point where they were so high, they changed the rules. So we now have a much lower loan modification reporting threshold that says you only have to report what you modified in the last 12 months. You don't have to report life to date. But if you go and look at Bank of America, and I showed you the delinquencies on their CRE portfolio, they've modified pushing 11 to 12% of their commercial real estate book. These are unheard of levels.
Wow.
So all these things are doing are they're an attempt to keep valuations up here. Every asset class got overvalued by
Right.
35, 40% at least because of the money. But we don't want to go back because no policymaker slash politician wants to take the pain, especially for someone else's bad decisions. We don't want to take pain. So we try to keep that valuation up here on residential real estate, commercial real estate, stock markets, bonds, everything. These valuations are enormous. I don't see how we get out of this without value destruction. Or we prolong this for 7, 8 years of an economic malaise. Unless
Mhm.
there's some massive growth that's going to take place to grow us out of this, which maybe, but I'm less skeptical that that's going to be the solution. I think
Yeah.
we're going to end up in a long-term economic malaise because banks won't lend anymore, except for NDFIs, and
Right.
we never get a reset on the valuation, right?
And rather than take write-offs, they just they just continue to modify the
Correct.
terms down to a point where we're like Greece or Italy or something like that.
Correct.
Right?
The only thing that will change this is if the community bank segment gets into trouble, and then we'll blame it on the community bank segment because they want more consolidation. I don't know
They do.
why. I don't know why, right? Every
Well, we have over 4,000 right now banks and credit unions in total, I think, in the country.
well,
Which
4,300 banks, but we had 9,000 when I started BankRegData 17 years ago.
really, I did
Yes.
not know that.
And we had 13,000 when I first started playing with the data set back in 2004.
Wow.
So in your life, I think we're of a similar generation.
Yep.
Can you name an industry where it got better when we had fewer competitors? Insurance,
Look at the
education,
agriculture industry now.
agriculture, yeah, right, agriculture, you name it. And so whenever you see consolidation down, you know that it's going to be crappier, right? Your service or your good is going to be degraded because of this. And they want that for banking. I don't know why, but I think I know why. I think it's because they need somebody to buy all the treasuries that they're printing. And it's easier to get the big banks to buy the treasuries than the
Yeah.
community banks who want to lend. But if the community banks stumble, I don't think they're going to get the same rules, allowances, or the exceptions on a bunch of extend and pretend. But right now, the community bank segment, pretty much, I mean, there's always some examples and exceptions. The community bank segment is very, very strong. It's the
Good.
biggest banks that are most problematic.
It's great. It's great to hear. I'm all about, fallacies of the media counteracted with the data and the reality of insider perspectives. So.
I used to think there was this big invisible hand, specter, hydra, whatever you want to call it, pushing narratives. I somewhat still think there is that going on, but I will also tell you it's very much a copycat industry. When somebody writes an article about community banks have the highest CRE concentration ratio, my phone will ring from every single major periodical and news press, and they all want the exact same story. So if you wonder why the same story comes out in multiple outlets at the exact same time, part of it may be Hydra, right, pushing that. But I think a very large portion of it is the copycat nature.
Yeah.
But I'll tell you, big bank reporting and criticisms is not a subject that is easily discussed. Nobody wants to talk about big banks having problems. It's all the community banks that are problems because they're anonymous. Right? We don't know those guys, and they don't advertise with us.
Yeah, not too big to fail, is the thing. And you're right. It seems like we live in a world where absolute power corrupts absolutely, so to speak.
That's a little bit beyond me, but yeah, I would prefer to have a lot more smaller banks. Small banks are the only ones doing the heavy lifting on commercial real estate lending, consumer lending, multifamily lending. It's the community ag. It's the community banks that are the lifeblood of credit. The biggest banks have completely abrogated that and are so focused on NDFI lending, which is this big black hole of a bucket of stuff that we don't know. We're going to get a painful education. It's coming.
I love your predictions. May you have a wonderful Thanksgiving and Christmas and New Year's and Hanukkah, whatever you're celebrating. You heard it here from a man who knows the data of bank calls reports. Bill, I really do appreciate your time today.
Likewise, Bill. Thank you for the opportunity. You have a nice Thanksgiving.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.